I'm looking for a trade setup in Zoom, ticker symbol ZM, going out to July 30th expiration cycle. I talked about selling an out-of-the-money call spread in Zoom because I did see a bearish sell signal a couple of days ago. However, looks like the market character is changing a little bit. We are seeing some pretty decent underlying volatility in these high beta tech stocks, and Zoom happens to be one of them. Just looking at a chart real quick, it looks like it's putting in a small bear bull flag here, and this is not bearish by any means. Trend is higher as all moving averages are pointing higher, and if this trend continues, could probably run into 400s. However, things could change quick. One trade I am looking to put on, I want to have no upside risk, and if we do have downside move, as long as it's not a 20 or a 30% correction in the stock over the next month or so, I think that setting up a structure that is a Jade Lizzard, where we are short either at the money or slightly out of the money call spread, and we cover all of the risk to the upside by selling an out of the money put. So in this case, I'm looking at selling 375, 380 call spread. This call spread is going for about $2, and if I sell an out of the money call spread collecting $2, my risk in the trade is $3, right? It's a $5 wide call credit spread. Collecting $2 leaves me with $3 worth of risk to the upside. I'm going to sell a 315 put naked for $3.90. So this $3.90 credit will cover my $3 risk of the 375, 380 short call spread. This leaves me with no upside risk. I have about 95 cents, maybe $1 of max potential profit if the stock is above 380 at expiration. If we are inside 375 and 315, the most I could make is $2 that I will collect from the 375, 380 short call spread, plus the 390 that I'm going to collect from 315 put naked. This will leave me with a max upside potential inside of 315 and 375, somewhere around $6 or $600 per one spread. Selling 315 naked carries a lot of risk, right? If the stock goes to 200 and the 315 is deep in the money, we're going to face a situation where we would have to potentially either take the stock or take a big loss. So please be aware. Margin requirement for this trade is somewhere around $3,000. So if I can make about $600 with $3,000 of initial risk, this will represent about a 20, maybe 21% return on margin. What we can also look at is buying a cheap wing to cut our risk to the downside in this trade. So if I'm left over with about 95-cent credit on the upside, I can use that credit to maybe buy a 270 put, right? So 315 is not naked. I'm short 315, I'm long 270, and that cuts my risk down to about $4,000 per one spread. So it doesn't necessarily give me any advantage from a buying power point of view, meaning if I sold 315 naked, my buying power reduction is about $3,000. If I did a 315 270 spread, my buying power reduction is still about $4,000. So I don't gain anything by doing the spread, but what it will do is, in case the stock, gets hammered and it goes to $100 a share over the next 30 days, I know my downside risk is limited to $4,000. So the trade setup, what I'm looking to do is selling a 375, 380 call spread, and I'm going to sell a 315 put naked for now. I'm looking for this stock to be, if the trend that we are currently seeing continues and we're above 380 to the upside, there's no risk this will result in a small profit. But the meat and the potatoes in this trade, so to speak, is inside of 375 or underneath 375, but above 315 over the next 30 days or so.